Welcome back. Well, the Fed has spoken and the market doesn't like what it hears, even though it's cut the Fed funds rate down to 2%. The dollar is down after this, and so are bond yields, and that's a clear sign that people now think the chances have grown that there will be more rate cuts in future. That should normally be good for stocks. Stocks like rate cuts, but stocks have actually ended down for the day, having had a very strong day up until the Fed announcement. So what's going on? As ever with the Fed, what you need to do is look at what they have left unsaid compared to their last statement back in March. And the key new change is that they no longer say downside risks to growth remain, in as many words. That does seem to be some kind of a clue that they don't see the need to keep cutting interest rates. However, they haven't changed their language on inflation at all. They still don't seem that concerned, even though many other people are. And perhaps most surprisingly, they haven't changed their language on financial markets, which they say still remain under considerable stress, even though, of course, credit markets in particular have improved quite a lot since March. Overall, there's one possible explanation for this, is that the Fed doesn't want to be too explicit. It's learned a lesson that too much transparency can be a bad thing. But I think what is worrying the stock market is that one explanation is that the Fed doesn't like what it sees going on in the financial markets, and although it doesn't want to say so in as many words, wants to leave its options open to make further cuts in case that's necessary to help problems in the money market in future. But for now, I'd like to make a couple of points about the way the investment world has changed since the Fed started cutting rates last August. First of all, let's take a look at the winners and losers. And you can see that the MSCI World Index, which covers developed economies, has been virtually flat since then, while the Emerging Markets Index is up about 20%. That's strong performance, but it hides the big corrections we've seen in China and India. The really big winner of this period of Fed easing has been Latin America, which you can see there has been up as much as 50% over this period. Now, that's not because there's been a big economic miracle in Latin America. Rather, it's because of commodities prices, which have gone through the roof, and obviously there are a lot of commodity exporters in Latin America. And secondly, it's about a search for value. Latin American stocks tend to be cheaper than Asian stocks, and that brings me to this second chart, which shows you how emerging markets valuations have compared to the world index over the last decade. And you can see that last year was the very interesting moment when emerging markets actually moved to a premium compared to the developed world. That remains in force, but you can see the gap has narrowed in the last few months as fund managers have increasingly looked for value. However, now let's take a look at the S&P 500. And you can see very briefly in the emerging markets even traded at a premium to the S&P, but in the last few months the PE on the S&P has gone up very sharply. Now, and it's at its highest level in 3 years. Now, some people will dismiss this, saying, well, it's because there have been big one-off losses in financials that nobody expects to continue, but it should still give pause to those who think that US stocks are particularly cheap, that the S&P is in fact more expensive than it's been for quite a few years, and that it now trades at quite a big premium to the rest of the developed world and to emerging markets. I'd like to return to Latin America today because S&P upgraded Brazil to investment grade on Wednesday afternoon, and that had a quite remarkable impact. Take a look at this. This shows you the spread of Brazilian bonds over treasuries. It's a pure market expression of where they see the default risk of Brazil. And you can see that throughout the last year, those spreads have been below 300 basis points. That normally suggests that the market is comfortable with the idea that Brazil is an investment grade credit already, even if those spreads have widened as people have got nervous during the credit crisis. Now let's show you what's happened to the stock market over that period. You can see it's enjoyed a huge rally. It's been one of the big success stories in world markets, but it had a remarkably strong reaction to the news on Wednesday, even though, as we've seen, many in the market regard Brazil as quite a safe credit anyway. It was up more than 6%. To put that into context, the rise in the Bovespar's market cap in the hours after the S&P's decision was greater than the total value of the whole Bovespar was just 6 years ago. Quite an extraordinary response. Now, there are reasons why an upgrade by the S&P will have an impact in the real world. A lot of public pension plans are limited to only investing in credits which S&P says are investment grade. Therefore, a lot more money will be coming to Brazil as a result of this. However, I'd still like to caution that this looks like an overreaction by looking at what happened when Mexico got investment grade back in 2002. Obviously a very similar country in many ways. This is what happened in the year leading up to getting investment grade. You can see that credit spreads were tightening, although they were still considerably wider than Brazil's are now, and the stock market was rallying. And now let's show you what happened in the year afterwards. Initially, euphoria, stocks continue to rally, and credit continues to tighten, and then somewhat of a correction. Now, I think there is quite a strong risk, particularly given that Brazil has been in the kind of rally that Mexico wasn't enjoying 6 years ago. I think there's quite a significant risk that something similar will happen in Brazil. Quite simply, the opinion of one rating agency just shouldn't make that much of a difference.